Hello everybody, this is Darshan and I am with you today for the second edition of Dorsey's Market Alert. Today is Monday, December 8th, 2014, and boy did we see some action in the markets today. Many of the recommendations I have been making over the last few days have come to fruition. We had VIX surge over 14. Bonds and gold were up big time, as well as XLE, the energy ETF, and emerging markets, the EEM, both tanking somewhere in the range of 2.5% to 4% down at the lows today. So big risk off day. As far as the US dollar strength, that didn't quite transpire, but the dollar was down only marginally, 0.2, 0.3%. The transports definitely took a big hit as well. Let's just go ahead and look at our outline here. We're going to go ahead and take a look at the SPX chart and the VIX, see what we have in the short range future, and we're also going to take a look at relative assets and what our sectors and sector rotation are telling us. Looking for a crude oil bottom. Is it going to happen? After the energy company smashing today, it seems like oil is going to follow suit, but not necessarily. And we're going to learn how to play relative volatility using a couple different metrics. And then we're going to go ahead and wrap up with hot stuff. On each one of these episodes, I'm going to be picking my top asset, sector, and stock. So go ahead and stick around for those. And if you like what you see here, go ahead and like and share on any of your social networks. And if you do that, go ahead and tag me on it or send me a quick email or link showing me where you shared it, and I'll cruise through your stuff and return the favor. So like and link away. Thank you. All right, in terms of our relative assets here, like we said, the US long bonds, TLT is the closest ETF proxy, did very well today, up 1.22% and topped out all of the relative assets. Gold was not too far behind at 1.18%, and utilities and surprisingly financials actually did fairly well today, all in the green. Well, at the bottom of the range, we had the emerging markets were really hit hard, down 1.47%, and basic materials and energy led the pack, was in the very rear, down over 4%. So a really bad start to the week and a very bad day for energy so far. So let's go ahead and take a look at what we can expect for VIX. This is StockTwits, and we are simply looking at the number of messages for VIX from basically mid-October when we saw the low. We saw peak messages here, 1073 for the VIX symbol on StockTwits, and a huge collapse as risk rallied since that point up until just about last week, where messages bottomed out at almost a tenth of that number. Now we're starting to see a slight uptick, but we are far below, which from a contrarian perspective tells you that, well, when messages peak out, that means that VIX will probably peak out. So VIX could have quite a ways to go here before this thing is all done. Similar thing going on in sentiment here, even though it looks like people have been commenting bearish, bullish based on their market risk outlook rather than the VIX as an instrument itself. So you can see here back in mid-October when the VIX peaked out, you had 75% bearishness versus 24% bullishness. So about 3-to-1 bears to bulls there in terms of the market itself. And what do you know? That was a bottom in risk and a good time to buy risk and sell the VIX. Versus where we find ourselves today, 27% bearish, 72% bullish. So we're almost at the other extreme, which indicates to me that we have much further to go on the downside for risk markets, and we're going to see VIX quite a bit higher. Definitely in the upper teens, maybe even with a 2 handle within the next week or two. So we'll see what happens with that. In terms of the S&P or the SPY here, we see that we had a big red candle today, which actually closed below the Ichimoku conversion line or Tenkan line, which was at about 206.9, 2069 roughly on the S&P 500, which is a big sign because that means momentum turning. We haven't really had one of those in a serious way since 9/22. So we're starting to see a lot of echoes of last September going on here. And as you can see from September 22nd, the price action really never came back above that, that conversion line again. So definitely a little bit of a bearish sign right there. We also have some Fibonacci retracements, and if we're looking for support on the downside, the 75% retracement, the first level of sort of firm horizontal support going all the way back again to those fall highs, is at about 201.8. So somewhere around 2017, 2018 is where we'd find the first level of support. Drilling down to the 30-minute level, we're seeing a very bearish chart here. We're well into a red Ichimoku cloud phase, which we have plunged down below. We got a good signal off of the cross of that white conversion line and the green Tenkan baseline. If we look at our volume, we definitely had some big selling, but it was on a correction. So that leads me to believe that we're going to have another leg down, maybe even an equal measurement, which could take us down quite a bit lower tomorrow in the next few days. Also, we're taking a look at our momentum here. This is our MACD with an RSI overlaid, and right now we're still getting some big down bars on the histogram, the turquoise histogram here, and the MACD line in red is well below the blue signal line, which is what that histogram bar is representing, is the gap between those two. So no sign of momentum turning up yet. And meanwhile, we have our just kind of simplified RSI still at about 35, which is definitely bearish. We want to see that above 40, preferably above 50, before we can really take a bullish interpretation of that. So this being the 30-minute chart, that roughly translates into kind of a 1 week, 5 trading day outlook. So right now, the 1 week outlook is bearish for the S&P 500. All right, taking a look at our C-Suite, which, by the way, the holiday suite deal is still on, so check my links below for links to both the Dorsey Intel site and that suite deal. It's only $10 a month to get access to this model, which gives you the S&P targets way out here, 3 weeks. Look at that, S&P targets. The average variance on this model is less than 1%, so you can expect price to be 1% within each one of these price targets on average. You also have buy and sell targets, where right now we're at 2023 and 1975 buy level. Those are descending on either side of the price targets, but right now those are our buy and sell levels short term. And we also have a correlation between this model and the S&P itself. So right now that correlation's been pretty high. We've been above 0.7 for several days, weeks now. And then another useful indicator is also variance trend, which is actually a leading indicator which can tell us sort of what kind of divergence to possibly expect between the model and the SPX. So one example of that would be back here during our 1016 low. It was actually below the zero line here. Variance trends were negative, which told us to expect the S&P to actually diverge lower than the model itself, which is exactly what we got. So it looks like that's going to persist with negative divergence for a few more days here, and then swing back up to the positive. Although, as we see from the model here, the SPX still has quite a ways to get caught up to those 1980-ish levels projected for this week and next week. So definitely watch out for that, and looking for a bottom sometime just before Christmas or right at the end of the month, closer to 1900 than not. So definitely keep an eye on that. All right, so let's take a look at what sector rotation is telling us. This is kind of a classical model. It's based on the business cycle, which many of you may have learned about in business school or your economics courses. And basically how it works is the real economy and the markets are, surprise, surprise, actually linked to each other. It's just they're offset by anywhere between 1 quarter up to 3 or 4 quarters, up to over a year. So typically you'll see the markets actually leading the real economy, and certain components, certain sectors within the market will be relatively stronger than the others based on what section of the cycle that you're in. So one way that we can actually use this in reality is to take a look at, well, hey, we've got our sectors right here on FinViz, all ranked by 1 month performance. So if we want to look at on the quarter, well, on the quarter we can see that healthcare, consumer goods, services were all strong. And then for the month, we can see that still healthcare and services are strong. So if we're seeing strength in healthcare and services, which are lumped together in this model into healthcare, that's telling us that we're actually in the very peak of the real economy, basically, and we're actually entering a bear market in terms of the economy. So that's definitely something to watch out for with our risk. Is, you know, we're definitely entering a bear market, and the way that the rotation of these sectors works is it just moves forward, kind of like a sine wave, essentially. So after healthcare, we'll see strength in utilities. And typically, you'll see about 1, 2, 3 sectors back, you'll see the weakest performance in those categories. So what do you know? We've seen incredible weakness in energy over the last few weeks, especially today. And then we can expect to see the most weakness of all sectors likely in staples. So definitely keep an eye on that. What else can we see here? Well, let's drill down to our smallest performance measurement here, which is the weekly basis. And surprisingly, look what we see here. Services is dropped from number 2 to number 6. Well, utilities actually spiked up. So we're finally starting to see that on the 1 week basis. Our sector rotation is happening. Utilities are growing stronger and services are growing weaker. Interestingly, in this this index of the sectors, both consumer durables, staples, and consumer discretionaries are all lumped together into consumer goods, which are definitely weak. So even though there's a very cyclical component in it versus the durables component, we will see the staples start to really come down here. And then eventually healthcare itself will start to become much weaker. Okay, and sort of the final component in here that is a little bit more, puts a little bit more of a lens on this phenomena of sector rotation are the insurers. And so I've picked the classic insurer here, which is Berkshire Hathaway, Berk A, which is Warren Buffett's big conglomerate. It's financials, they own railroads, they own a piece of everything, but first and foremost, they are an insurer. And you'll see here, again, this October example is just so great from this pullback. You'll see this is actually the ratio of Berkshire Hathaway to the S&P 500. So whenever this goes up, it means that Berkshire Hathaway was growing relatively stronger than the S&P 500, and vice versa. When the ratio is falling, it means that the S&P 500 was growing relatively stronger than Berkshire Hathaway. So you'll see this sort of defensive preference for Berkshire Hathaway as the collapse began. The whole time it was rallying relatively to the S&P 500, even as the S&P 500, this black line, was coming down into the middle of October. So that's typically a sign you can look for, is if the insurers are rallying, if especially the rate of change here, if it gets above about 1.7% on a 1 week basis, which we are actually over here. We're at 1.96 as of today. That is definitely a sign of danger, danger approaching, because insurers are sort of the last resort. And what that really is going back to is that what is the major asset that insurers own? Bonds. They're one of the major buy-side purchasers of everything from U.S. Treasury bonds to corporate bonds to sovereign bonds, you name it. So it's analogous to the flight to bonds when people are buying the equity of an insurer, because you're essentially buying into their bond portfolio and their bond holdings. The only problem is that that insurer is still probably correlated with the broader markets, especially the S&P 500. So at some point, that insurer is going to come down, even though it may rally on a relative basis. So the fact that we're seeing this happening means danger ahead. Not necessarily an October level correction, but we should be looking for something